How much tax do you pay on a $40,000 Roth conversion? Hi, it's financial planner Sean Mullaney. Let's discuss. So Roth conversions, folks love Roth conversions, particularly in the earlier parts of retirement. But there's a question. Just how much federal income tax do you pay on that Roth conversion? Nobody likes writing a check to Uncle Sam. So it's good to have some understanding of the federal income tax due on a Roth conversion. And everybody's example is a little different, but I have a scenario here that could be somewhat typical for a mid to late 60s-year-old married couple, both retired, relatively affluent, right? Not ridiculously wealthy, but certainly affluent. And let's see just how much tax they might pay to Uncle Sam on a $40,000 Roth conversion. And this is Robert and Natasha. They're married. They're going to be 66 at the end of 2025. And if we look at their numbers, right, they're living off taxable brokerage accounts, which means what they're doing is they're selling mutual funds or ETFs, and that triggers capital gains. And those mutual funds and ETFs spin out some dividends, so that's going to be taxable. So let's look at their initial tax return for 2025. Interest income, small savings account, fine, $2,000. Qualified dividends, $10,000. Non-qualified dividends, $4,000. Long-term capital gains, $85,000. Now, how much they're living on, we don't know, because the long-term capital gains is the net. So they're selling, say, $160,000 to fund their living expenses, but they have $75,000 of basis, for example. That could be it. So their net capital gain in that example is $85,000. Maybe it's $200,000, but they've got $115,000 of basis. We don't know, but we can assume that they're living off six figures, so they're doing great, right? Their retirement is going really well. They're living on more than $100,000, almost certainly. And that does trigger $85,000 of taxable capital gains. So we have to consider that when we think about the cost in terms of federal income tax for a $40,000 Roth conversion. All right, so their adjusted gross income is $101,000. That's a healthy number in retirement. Now they get some deductions though. They get a $31,500 standard deduction. They get an additional standard deduction. And new for 2025, they get a $12,000 senior deduction. So look at all these available deductions. This is really interesting to me. Their available deductions without itemizing is $46,700, obviously a very high, healthy number. It strips away from taxable income almost half their adjusted gross income. So their preliminary taxable income before any sort of Roth conversion, okay, $54,300. All right, so where does that leave us? Well, that leaves us in a place where they have deduction that they could use against ordinary income, right? They have that $46,700 deduction, but their only sources of ordinary income before a year-end Roth conversion are $2,000 of interest and these $4,000 of the non-qualified dividends. So they've got $40,700 left in terms of deduction that they could use against ordinary income. So that's what they're going to do. They're going to do before year end a $40,000, and it's not even $40,000, it's $40,700. They round it up just a bit. $40,700 Roth conversion, a very healthy Roth conversion before year end. And that's going to up their taxable income away from this $54,000 all the way to $95,000. So you say, well, okay, that's probably going to have some attendant federal income tax expense. Well, I want you to mentally, before I reveal the federal income tax that they're now going to pay, I want you to mentally say, all right, how much federal income tax is that going to be? Is that going to be $5,000, $10,000, $15,000? Just kind of mentally guess in your head what the federal income tax number is, and then I will reveal it. So through the magic of the internet and Google Sheets, hopefully this will work. Their federal income tax, my friends, zero, nada, zilch. Okay? They have no federal income tax when they live off $85,000 of capital gains, have some dividends, have some interest, and a $40,700 Roth conversion. And now you're shaking your head. You're like, no, 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 Sean, there's no way they pay zero federal income tax. Well, all right, I did a tax computation, so we can go over this together. And I got to lower the view so you can sort of see everything that's going on here. I'll up it a little bit. But they really do pay zero federal income tax. And the phenomenon, I'll just show you, there's the computation. The phenomenon here is income stacking. So when we tax income, we have two different types of income to tax. We have ordinary income, so that's interest, non-qualified dividends, W-2, Social Security, retirement account distributions, and Roth conversions, right? Pretty much it's everything except for two things: long-term cap gains, qualified dividends. Those two things, long-term capital gains, qualified dividends, they have a separate and more preferred rate structure. The 0% rate, the 15% rate. And so what we have to do is we have to income stack to figure out, well, which do we tax first? What we tax first is the ordinary income. And only after the ordinary income has been taxed do we tax our long-term cap gains and qualified dividends. It's actually very helpful typically for most taxpayers. So I then think about our taxation every year as layers. And we start with our ordinary income layers, and we apply the standard deduction, 10%, the different brackets there. And then on top is the long-term cap gains, and we apply the long-term cap gains rate at that point. So our level one is our interest income. $2,000, $31,500 standard deduction. We know that's just tax-free. The standard deduction soaks that up, no problem whatsoever. Okay, that's fine. But what about our non-qualified dividends? Well, a very similar result. Zero federal income tax because the standard deduction is more than sufficient to soak that up. But aren't we going to pay tax on the Roth conversion? The answer is no. Why? Because we still have $25,500 of the standard deduction. We applied that against the $40,700. We have our little additional standard deduction, $3,200, and our senior deduction, $12,000. By doing that Roth conversion to the top of the available deductions, we basically put our ordinary income, once we apply the deductions, at zero. So we pay zero tax on all that, including the $40,700 Roth conversion. Well, okay, that's all well and good, but what about our dividends? That was long-term or qualified dividends were 10, and our long-term cap gains were 85 in the example. That's 95,000 of income. Surely the IRS gets a piece of 95,000 of income. No, they do not. Look at this. The 0% long-term capital gains rate in the year 2025 for a married couple goes to 96,700 of income. Well, this couple's a little below that. They're at 95,000 of taxable income. So guess what? All those dividends that are qualified and all those long-term capital gains go off at a 0% long-term federal or long-term cap gains federal tax rate. Wow. Holy cow. This is such a great result. This illustrates the power of planning. And, for many retirees, it turns out taxes in retirement are quite light. This is a couple with an adjusted gross income of over $140,000, yet they pay zero federal income tax. And by the way, they got $40,000 plus from a traditional IRA to a Roth IRA, didn't pay a penny of federal income tax. And I think this is counter to a lot of what we see that says, oh, taxes in retirement are going to be terrible. And it's time to reassess all that. Despite the commentators' warnings, taxes in retirement often, not always, but very often, even for very affluent people, can be very low, and it benefits from good planning. And so I've got a resource on that if you're interested. I'll hold it up here. It's a new book that's now out that my co-author Cody Garrett and I wrote. It's called Tax Planning to and Through Early Retirement. And surprise, surprise, this example comes from, in the paperback version, pages 205 and 206. And Cody and I take the approach of no fear, no incoherent worry about RMDs, widow's tax trap. Let's break it down. Let's look at the tax rules. Let's look at tax strategy. And are there ways that we can lower total lifetime taxation by taking advantage of opportunities just like this? And, look, we worked our hardest on the book. It's not a perfect book, but we think it makes a really good contribution when we're thinking about taxes and retirement and good planning strategies that could help, for example, get $40,000 into a Roth IRA in 1 year. By the way, this married couple, in theory, could repeat this in 2026, 2027, and 2028. So that's pretty cool. Let us know what you think in the comments below about examples like this. Do you have questions? By the way, the book is a great resource if you have questions, but drop them in the comments below as well. Thanks so much for watching this video. If you enjoyed it, please mash that like button and subscribe to my channel. I will see you next time.